Welcome to the slide presentation portion of today's show. This is episode 9, Purchasing Options in Today's Real Estate Market. We've thrown this into every category. Mortgage process, first-time homebuyer, programs and guidelines. Everybody should pay attention to this presentation if you're looking to make an offer on a home. First things first, let's break down the lending landscape. So lending always comes down to who buys, and then that ultimately determines who owns your mortgage loan. So you've got government sponsored, as in Fannie and Freddie, and then you've also got the private sector. If you're on the government side, you've got FHA and VA. FHA offers up to 96.5% financing for any homeowner that wants to buy a home. And then you have VA financing specifically for veterans, where you get 100% financing with no monthly mortgage insurance. So it's a great program out there for veterans. If it's not government, then it's conventional. Conventional has two subcategories, conforming and non-conforming. Conforming is basically A paper. A paper are loans below 417, 680 plus FICO score, 2836 debt ratios, which are your percentage of your income, and a 20% down payment. They're very low risk loans, and that's why they qualify for Fannie and Freddie guarantees. That's what's called conforming. They conform to Fannie and Freddie guidelines. If they don't conform to those guidelines, then they're considered non-conforming. And non-conforming has two basic categories. You have Alt-A, which is basically alternative to A paper. That means you have a high enough FICO score, but the loan amount's too high, the percentage of your income that's going towards debt is too high, and you may lack some income documentation. On the subprime side, that's high risk, high stakes lending. I mean, this is basically everybody that has a low credit score, low down payment, couple bankruptcies. That was what subprime was all about. Now, subprime and Alt-A really don't exist anymore, but this is not about lending new money. This is about the fact that back in the days, we're talking about 05, 06, 07, when the market was hot, a lot of loans were Alt-A and subprime. So that means a lot of these loans were owned by Wall Street, and that's going to determine what happens in your short sale, your foreclosure, and all those other types of transactions. We're going to focus today on the ownership of a mortgage. Once the mortgage is made and it turns into an investment, that's how we're affected in terms of what goes wrong once you start making your mortgage payment. How the mortgage is made. The mortgage becomes an asset or an investment when it moves from the primary market to the secondary market. In the primary market is really where you go to get your mortgage. Once you get that mortgage, the lender then has to make a decision as to whether or not they want to retain that mortgage on their books and go around and collect your mortgage payment and receive that long-term cash flow, or they want to sell it today in the short term to either a whole loan investor that owns your whole loan, or break it up into a bunch of security investments and have security investors buy that. So depending on their decision, that really determines on what happens when you have an issue with your loan down the line. It all comes down to who ultimately owns your mortgage. When you do a mortgage, you go to a mortgage originator. Whether you're dealing with a bank or a banker directly, or whether you deal with a broker who brokers your loan to a bank or banker, that's all considered the primary market. There are other primary market players involved, like in the case with Fannie and Freddie Mac, where they can guarantee the on-time payments of your mortgage because your mortgage conforms to their guidelines, or a mortgage insurer gets involved when you borrow above 80% of the home's value. So in other words, you put less than 20% down. So if you put less than 20% down or your mortgage conforms to Fannie and Freddie guidelines, all these parties are involved in your mortgage. Now, like I said in the previous slide, in certain markets, Fannie and Freddie were not as involved because the loan sizes were too large. Once the loan is made, again, a decision must be made. Does the lender want to retain your mortgage and keep it on their books and collect the mortgage payments for the long-term cash flow, or do they want to sell it right now and get that short-term gain? Regardless of the decision, neither time do they service your mortgage. They usually involve another servicer who's actually going to service the mortgage. Now, I want to point something out. Around the turn of 2003 and 2004, a lot of lenders and investors got into the business of servicing. Banks really like this business because they figured they can service your mortgage and then get you to buy credit cards or open, accounts or do all that stuff. That's what they looked at as the value of a servicing portfolio. But as we found out over the last couple of 3 years, really, it's been a horrible business move. But servicers don't really own your mortgage. They don't really have major decision-making power. They're just the ones collecting your payment and providing a customer service department for you to deal with when things go wrong. So I kind of feel bad for the servicers because even though they got into what looked like a good business, ultimately ended up being a bad business move. Secondary market. Secondary market is when the mortgage that you got becomes an investment that an investor owns. This is where the investor is completely separated from your situation as a borrower. They're looking at this as a return on their investment. So whether you're talking about like CalPERS, your 401k investors, or any other investor that's out there that's institutional or otherwise, they are looking for a return on their investment. And as they look at it, they have invested money expecting that return. If the lender chooses to retain it on their books, then it becomes a portfolio loan. Portfolio mortgages are the best case scenario for a borrower in trouble. Because if you have a portfolio mortgage, that means that the lender that's probably collecting your payment or the lender that's involved with the servicer has a very good relationship with your mortgage loan and is able to make decisions immediately because it's in the portfolio. If it's not in the portfolio, the next best scenario is that it's sold to a whole loan investor. That was an investor that owns the whole mortgage. So that means they're able to make a decision on what happens if you need to short sale, if you need to do a loan modification, and all of those different options. If it's not, and your loan was not sold to a whole loan investor and it wasn't retained in anyone's portfolio, that means it got sold purely as a security. Oh man, and the worst thing in the world about this is that you could have one investor in that security, but more than likely you have multiple investors in that security, and nobody can agree on what to do. This is why it's so frustrating for you to be involved in a mortgage loan where it's in a security. And that's why you see the nightmares. When you hear about the good stats about how the loan modification went well, the short sale went well, that's probably your portfolio investor. When you hear the nightmare stories, that's probably your security investor. And in between that, you've got the whole loan investors. So it really just depends on who owns your mortgage. So there's really no reason to be yelling at these servicers as if all of these loans are equally treated. You hear a lot of talk about the investor approval or servicer approval, or we have to wait until the investor gives us the word. But really what it comes down to is the pooling and servicing agreement that was put in place when that loan was first sold. That dictates the terms under which the servicer can service your mortgage or make any changes. What's never debated is whether or not the servicer can foreclose, and that's why you see foreclosure as the first option. It's when the servicer tries to do a short sale or a loan modification is when that person has to then interpret the contract. They have to look at that contract and see what the terms are. So when you think about that, that's really the issue. It also gets further complicated if guarantor or mortgage insurers are involved. If Fannie or Freddie guaranteed your mortgage, they have a say. If the mortgage insurer provided insurance on your mortgage, they have a say. So everybody's referring back to this contract to be able to determine what ultimately happens on your short sale or loan mod. Buying a home in today's market. Buying a home in today's market can be extremely tricky. And that's because some home sellers or homeowners that are selling their property are trying to get out from underneath some kind of hardship. So you want to ask, what's the foreclosure status of the property? Good question for the listing or selling agent. If you look at the foreclosure timeline, the first thing that happens is usually the borrower falls 3 or 4 months behind on their mortgage, and the bank starts to talk to you privately about what you can do to fix the problem. If you don't respond to them within a timely manner, the bank then lets the whole world know that you're behind by filing a notice of default. Now, when they file that notice of default, it also becomes public record, and now you can search to see if that property has an NOD. At minimum, you want to make sure that whatever property you make an offer on doesn't have an NOD, or if it does, you want to make sure you understand all the details. The next is a notice of sale may be posted. If the person doesn't respond within that 90-day period after being 3 or 4 months behind on their property, the bank then starts to position themselves to sell it. And that's when they have a notice of trustee sale where they sell it at a public auction, usually setting the date for 21 days from the time it's filed. Once it goes to auction, it's either sold to a new owner or the bank retains it because they didn't like the offer and it goes on the bank's portfolio as real estate owned by the bank, aka REO property. Purchasing options. If you look at the different options that you have as a buyer trying to buy a property, There are a lot of options out there. The three majors are either a resale, where you have a normal owner that's trying to sell you a property, an REO, which is real estate owned by the bank, and then you have a short sale. On a resale, you just have a listing agent and a seller. You both come to terms on how the property is going to be sold and how you're going to buy it. Have a contract with contingencies. You clear the contingencies, you close on your loan. Pretty simple. REO is a little more complicated. You have a listing agent that lists the property. You make the offer. The listing agent then sends that off to an asset manager. The asset manager has been hired by the asset owner, which ultimately is the investor or the bank that owns that asset. Contractors can get involved if you need repairs done. And usually REOs can be pretty smooth transactions unless contractors are involved. And even then, if you've got a good lender and they have a good understanding of the process and everybody's on top of their game, you can close it on time. But just keep in mind is that once you get involved with the repairs, it can complicate the timeline. The most difficult transaction out there is by far the short sale. Why? Because the short sale involves the owner of the property asking the bank that currently services their mortgage or servicing company that currently services that mortgage to allow them to sell the property for less than what is owed. Example is they owe $500,000 and the market's only allowing about $300,000 for their property, so they're asking the bank to take $300 instead of $500 and let them close short. That's why it's called a short sale. So you make an offer on a property, listing agent and seller involved, they accept your offer, but that really doesn't mean anything until the servicer signs off on it. In order for the servicer to sign off on it, they're going to make sure that the offer that you've given and the hardship of the seller and the market value of the property all are in line with what the reviewer of the contract with the investor says. Because remember, these loans are owned by an investor. The reviewer is in charge of making sure that they know what that contract says between the servicer and the investor. So all these parties are involved, and that can complicate the process. This can become even more complicated if there's a foreclosure on the property. And you just want to ask the question, what's the foreclosure status on the property? If there's a foreclosure on the property started, then you want to know where exactly in the timeline it is. Is it a notice of default, NOD? Or is it a notice of sale where they're going to actually sell the property, NOS? Or when's the sale date? Because you don't want that property to be sold out from underneath you. So that's the foreclosure timeline. There can be other decision makers besides the investor involved, like Fannie and Freddie as guarantors, or the insurance company that may have provided some insurance on the mortgage if that original buyer bought and put less than 20% down. So why short sale is so complicated is because all of these parties are trying to follow this contract and determine whether or not that short sale is possible. That's why you see people having nightmares with short sales, but depending on ownership, people have a very smooth process with a short sale. Besides resale and REO, which are bank owned or even short sale properties, there are alternative places to get property. One of the best places is Fannie Mae itself. They have foreclosed on properties, taken them back, and because Fannie Mae guarantees mortgages and provides guidelines for lenders, they actually can make some of those rule changes to make it easier for you to buy one of those properties. That's what they've done in the case of HomePath. Fannie Mae says we foreclosed on these homes, and so we want to make it easier for them to be bought back by the market. So we've kind of, eased the guidelines a little bit. And that's been a great program for a lot of people to put down a low down payment and not have any monthly mortgage insurance. So look into that and make sure you're working with lenders that do HomePath mortgages. Next, you have NSP. NSP is Neighborhood Stabilization Program. It's the government gave money for neighborhoods that are in trouble or have a lot of foreclosures to be able to take them off the market and fix up the properties and put them back on to be sold. A lot of times with NSP, what you find is that they have over $50,000 available in down payment assistance. So for you as a first-time home buyer, or even if you're not a first-time home buyer, you can get up to $50,000 to buy one of these properties from the neighborhood inventory. Besides that, the local government also has below market rate properties through special programs that are available. I know there's a lot of talk about the RDA and how the governor plans on getting rid of them, but local government still has properties that they need to sell. So if you're a first-time home buyer out there looking to purchase, this could be a great source for you. Parting notes. Let's review what we talked about today. Primary market is where loans are made, and secondary market is where they're sold. Depending on who owns your mortgage, that really determines the ease of which you can get a loan modification, a short sale, or anything done on your loan. The ease of your transaction when you purchase a home is determined by the parties involved. If it's a short sale, you've got a lot of parties involved. If you're an REO, you've got the asset manager. If you're a resale, it's pretty simple. So depending on who's involved, that's going to determine the ease of your transaction. Always find out the foreclosure status of the property that you're making an offer on. You want to know if the property is in foreclosure, and if the owner is in foreclosure, you want to know what stage of that foreclosure they're in. I'm not discouraging anybody from purchasing homes that have already started the foreclosure process, but you just want to know where you stand. Plan your escrow timeline around the type of purchase transaction that you're doing. And I would also encourage people to make sure that they're very careful when the bank counters. Because if the property is in foreclosure and the bank counters, you don't have a lot of time to make a decision. So just be aware of that and make sure you're communicating with your listing selling agent and make sure they understand the whole process and that they're communicating that with you. So the market's crazy, but at the end of the day, I want to encourage everybody out there to purchase a home, but make sure you do so with a full understanding of what each option is. So now, by looking at this process and knowing how these different types of purchases exist, you can start to break down how that transaction is going to go for you. Thank you for spending your time with us at Homeowner Help Radio, where we help you get and keep your financial house in order.